The Doc's new investment option.
Lead Bullion.
Buy your ammunition from the Doc today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, early in the week we saw gold and silver pop back above crucial resistance points, particularly in silver. Silver flying its way back above $20, stayed there for a couple of trading days throughout the week. I think it was Wednesday and Thursday. And then sell-offs here late in the morning COMEX session, both on Thursday and Friday, after reaching a high of just above $20.30 an ounce on Thursday, with the low overnight Thursday into Friday. Smashing silver back under 20 and consolidating there a little bit. Move to the upside here in the access market on Friday. It looks like we're going to get an access market close just under $20, consolidating right now around $19.90 in silver. And the same thing with gold. Gold made a big move up through $12.50, crucial resistance that likely will turn into support here as gold was a bit stronger than silver throughout the second half of the week, maintaining those gains and even extending them here throughout the day Friday to close right around $12.70. So it's interesting, Eric, that gold throughout the second half of the week is holding a lot stronger than silver is. We were talking a little bit before the show. You think that might have to do with the deflation scare out of China, is that right?
Yes, I think that's what we're seeing being priced in both the equity markets and in gold and silver. You can see that gold, following the London PM fix today, was rising, and then actually is at this point may in fact close at a high for strictly New York trading and aftermarket trading. So that seems to be flight to safety. People who are concerned about return of their capital as opposed to return on their capital. When we look at silver, you see the exact opposite. After the London PM fix, and as the markets were trading along in the equity session, and then the Dow and the S&P and general equities just took a big dive as people are pulling out of risk assets, silver went down with it. And that is in keeping with the patterns that we've seen before, like in 2008. Silver dived much, much harder, much faster than gold. And then gold also caught a protection bid very quickly, or quicker, I should say, than what silver had seen when people were running for the exits. And this whole possibility of China seeing a default on one of these trust products to the tune of a little bit more than $450 million valuation is a significant risk to their shadow banking system, and the counterparties behind that could in turn become significantly weakened, and then you get a contagion effect throughout their credit system. So the fears are valid, and earlier this week we had a Treasury bill auction, a 30-day auction for 0% offering, which we haven't seen since the 2008 credit crisis. So people are very worried about trying to figure out how to stash large sums of cash if they in fact have it. The banking system doesn't offer much insurance. Money market products don't offer insurance. So when a big investor needs to figure out what they're going to do with $200 million burning a hole in their pocket or what have you, they're going to go to the T-bills because that's the only way that they can find safety in the storm for that size of money. And credit default swap rates are rising. We've had a number of emerging markets, like Argentina, for example, do devaluations of their currencies. So there's definitely stress in the international markets that are beginning to price in, and people are getting really edgy. And that default was scheduled for January 31st. And pretty much, with the exception of yesterday, the messages from the regulators and the bank in China were that they're not going to back the investors up. They're going to not permit moral hazard to be created where investors get the impression that they can just go ahead and buy whatever the heck they want, go after these 10% yields plus that are offered by these products and not have to worry about the underlying risk of the product itself. But the thing is that there's a huge amount of risk in that, and all of the authorities there are well aware of that. And there was a report on Reuters last night that bank who issued this credit offering is considering making whole somehow, some way, and to some degree, the investors that bought this product because on the assumption that the bank is going to take personal responsibility for creating an investment product that was shoddy in the first place. So all of this said is what's being priced in around markets right now. There's a lot of anxiety. The VIX rate shot up today, and people are just kind of jettisoning assets ahead of the weekend because they don't want to hold long anything. And in fact, shorts are being placed as well for hedging. The bottom line is that when you look at the silver market in particular, this is one of those rare instances where we can actually say, yeah, you know what, it wasn't manipulation that pushed it down, given the timing. I mean, it wasn't at the COMEX open, it wasn't in the early hours of the London opening or thinly traded access market hours after market. It in fact happened a couple hours after the COMEX open, and is a reflection of just assets diving across the board, with the exception of gold, which is nice to see because, in fact, it's actually performing as its historic role as a port of safety in turbulent times. But I would have to say, I guess the highest probability is that China is going to do some kind of bailout of this trust product because the risks are just too high. This is also happening in the context of Davos meeting going on in Switzerland, where all of the mucky-mucks from central banks and treasury departments and finance departments of countries around the world meet. And there's probably a lot of backroom pressure being put on China to do something about this product. So I think that that's what's going to happen, even though they've been saying all along that they weren't going to do it. The time will tell, and if that product just kind of fades away, then it'll be another can-kicking type of scenario, and it'll buy time for a few more weeks where the next crisis can be brought up on our show.
Right, exactly. Well, I want to touch back on a topic that we reported on in last week's show, Eric, and that's the German gold repatriation and the efforts to repatriate 300 tons of their own gold held in vaults abroad in London, France, and, of course, the New York Fed. Early this week, we actually got a little bit more details into the story here. And not only did Germany get recast bars back, but the numbers actually came out, and it's pretty astounding what they were able to repatriate in year one from the New York Fed. It was a whopping 5 metric tons have made it out of the New York Fed vaults across the Atlantic and to Frankfurt to the Bundesbank. And to put that number in perspective, just to give our listeners a little bit of a visual of how paltry a sum 5 metric tons is, particularly in the context of the Bundesbank has made an excuse or attempt to explain the reason that such a small amount was delivered is due to the logistics of moving such a large sum of gold around. I suspect that the official who claimed that it was a logistics issue has never actually held a couple ounces of gold, or much less 1 ton, or been in the vaults to see what the size of 1 ton of gold is, because 1 ton of gold is just over 1 foot by 1 foot in a cube. I think it's about 15 inches cubed. So you're talking 5 metric tons. That's about 6 feet by 6 feet. Really, you're talking 1 pallet over 1 year that they're claiming that the logistics are just too much to move more than 1 pallet in a year. So in my mind, when you look at the numbers and you have 5 metric tons being all that can be made out of 300 owed, well, really it's a lot more owed, but 300 requested from the Bundesbank. And the New York Fed said, oh, you can't have 300 tons all at once. It'll have to be over 7 years. We'll give you, I think it was 40, it was either 30 or 40 tons that were scheduled for year one. So not only would they refuse to deliver the 300 tons, which is only a small portion of Germany's gold reserves held at the New York Fed. So Germany only requested a small portion. And then the New York Fed said, oh, we can't even deliver that next year. We'll do that over the next 7 years. You'll get it slowly. And then they basically come up with 15% of the small portion that they agreed to give the Bundesbank. So rather than the 40 tons that they were scheduled to deliver in year one, a whole whopping 5 metric tons made it across the Atlantic to the Bundesbank.
Well, obviously the logistics problem was that, at 1 gram per ton mine rate in Nevada, it takes a while to collect all that gold.
That's true. That is a logistics issue.
Yeah, I mean, they got to refine it. I mean, come on, give them some credit.
And they weren't able to make it into Syria to confiscate any gold there. That's another logistics issue.
Yeah, well, give them time. So we have Turd Ferguson's TF Metals report, so thanks for whipping out his calculator and doing the numbers on that, and it was rather amusing to read. So, yeah, it all suggests that there is very little, if not maybe no gold as well, with the Fort Knox vault and the Federal Reserve, the Bank of New York. So, why? It begs the question: why would the Fed and the Treasury risk this level of embarrassment to send only 5 metric tons? And after all of the media reports and the scandalous announcement that it would take 7 years to repatriate the gold in the first place, you really just have to beg the question to whether or not there is in fact any gold left. It could in fact have been squandered in total. Who knows? I mean, we really just do not know. We do know that a heck of a lot of gold has been taken out of these vaults and or pledged to a great many parties simultaneously, with the multiple leasing and moving around of sticky notes and whatnot that goes on with the gold inventories at the Fed.
We do have some data that will be pretty interesting. Interviewed Jim Willey this morning, and that interview will be posted over later second half of the weekend or on Monday. And there's some pretty interesting anecdotal evidence that he had from a contact he has that was a former high-up official with Engelhard, the refinery, in regarding to the U.S. Department of Treasury status report on the gold-owned data. So you'll definitely want to check out that interview and listen to that. It's pretty interesting, their status report and how it changed around the year 2000 to 2002, and really indicating that about 2,000 metric tons of gold held at West Point was rehypothecated.
Was that also a period where they started using the term deep storage gold?
Exactly. The terms over a period of month, the description of the gold changed from gold bullion reserves to custodian gold bullion to deep storage gold, which means our friends out in Nevada.
Yeah, right. And typically bureaucrats are very careful with the words that they use, just by the nature of what it is to be a bureaucrat. They're very detail-oriented, and those words are probably selected for good reason.
Right. Jim Willey called it the smoking gun on gold rehypothecation and theft. So you want to check that out with his interview this weekend. But moving on to market update here in the wholesale market in the U.S. The Silver Eagles are slowly becoming available here, the 2014s. Several of the wholesalers actually have them in stock and are shipping. A few of the wholesalers that started pre-selling them early and kind of burned through their smaller allocations are still 3 to 4 weeks out. They burned through those allocations. But those who didn't start selling them about a month and a half early, they still have Eagles live and in stock, so they are available on the wholesale market. And the premiums really are holding steady. Maple premiums, pretty much the same. Maples are available, premiums holding steady, as well as generic rounds and bars. We're not seeing too much evidence, at least right now, of a major supply squeeze or constraint on the retail silver products. Premiums are up or elevated slightly from, I would say, levels prior to last April or May, but they have come down quite a bit since this summer. So not too much of an update here as far as any sort of supply constraints or delay in the silver market. The Sunshine Mint still is delayed a bit on their blanks, or their rounds, I should say. They also provide the blanks for the U.S. Mint, their rounds and their bars. The delay is easing up a little bit. I think it's down to about 2.5 weeks right now as well. On the gold side of things, the U.S. Mint continues to try to sell off its old fractional products for whatever reason that we humorously discussed last week. But other than that, really no shortage at all whatsoever in the retail market on retail gold products like the 1 ounce rounds, the small bars and such.
And over on the side of gold production, numbers from Thomson Reuters GFMS was announced this week, and it's kind of interesting that for 2013 there were 2,982 metric tons that were produced. It's about a 4% increase over 2012 levels, and it's counterintuitive to some extent given the price decline that we have seen. But the thing is that a lot of projects were already in the pipeline, and gold declined at a very rapid pace from April onward last year. So most of those projects were still in the pipeline, and they were breaking ground, and so their gold flow came to market. And then also a lot of companies that have been feeling the pinch for cash flow have been high-grading their mines and dealing with the lower prices by bringing to market gold that is easier for them to produce given the logistics of their mine operations. So it looks like those are the primary explanations for the total output of gold increasing by 4% last year. But 2014 is really going to be the telltale year, because given the decline in pricing, given the veritable collapse in the junior market and very limited flexibility for companies that are basically doing most of the discovery work, and just the overall difficulty for miners to get financing because the financial community is taking a very negative look at gold and silver mining projects, it's very likely that we'll continue to see mine closures and at some point maybe a net reduction for the year of around, I would guess, 10% is not an extreme estimate, and a lot of people will be poo-pooing that, but time will tell. This time next year we'll know. It'll be interesting to watch.
And then the one other thing, Eric, just to update our readers, is pretty interesting. The demand we saw for lead bullion, the ammunition products with the launch last weekend, particularly the 9mm and 22 sold out in under 60 minutes. Wow. 9mm was sold out in several hours, and most of the products were sold out within the first 24 hours. We do have some restocked and a couple more large inventory orders on their way, including a small amount of 22mm, which just continues to be extremely hard to get your hands on anywhere. It's been pretty amazing to see the demand really going quite beyond anything I've seen in the silver market in shortages, as far as people desperate to find 22, calling, emailing, asking to buy it as a pre-sale for anything we can get. And we're not selling any ammo that we don't have on our shelves. We feel pretty strongly that we only want to sell ammunition that we have and can ship right away to customers. And even after we tell people that, they're so desperate for particularly the 22 that they're still basically begging us to allow them to pay us now and send any 22 to them when we get some in, whenever that may be, 6 or 9 months down the road. So it's
hopefully not that long out.
Yeah, hopefully not. One of the readers or one of the commenters and contributors to SD that the listeners will know well, AGXIIK, he let us know he's already put in several pretty large ammunition orders, and he mentioned that he had an order with another online dealer that was placed last January. It was a pretty large order, I think it was about $5,000 or $6,000 worth of ammunition, and it was delivered in the end of July, early August.
Yeah, I remember him speaking about that, and that reminds me, because I actually put in an order at the same time I wrote that article about those 1,400 round 22 buckets and all of the other things that you could get. If you were to buy them all at one time, it would be putting them on back order, but you'd benefit from low-cost shipping and whatnot. And I haven't heard from those guys, so I better check up to make sure they didn't cancel my back order. But maybe you have to develop some kind of trading signal based on bullet sales. Now we're in a credit crisis mode where everyone's freaking out about the near term, and maybe you're selling out of bullets about a week ago was an early warning signal.
We'll see. I'm not sure how scientific that would be, but it could be.
Yeah.
All right. Well, we'll keep our eyes on that, and also in China as we head towards the 31st. Hopefully next week, the panic, the slight panic and the rush to cash and treasuries will subside a little bit and the fear will calm down.
But it is nice to see gold actually doing what it's supposed to do.
Right, and holding above 1250 is a pretty strong signal that we did see a bottom on New Year's Eve last year, a double bottom right around that 1180 level. So I think we'll wrap up the show here. So until next week, for Eric Dubin and the Doc, thanks for tuning in to the SD Weekly Metals and Markets.
The Doc's new investment option.
Lead Bullion.
Buy your ammunition from the Doc today at sdbullion.com.